All right. Hey, welcome back to the Confident Retirement Podcast brought to you by LPF Advisors. I'm your host here, Kris Flammang, as always. Joining me is my co-host and the resident CFP, Mr. Collin. Hi, Collin.
Hey, everybody.
He's going to help us break it all down. It's winter here in Florida. We've got our long sleeves on and our pullovers, but we are red hot with the information we're going to do today. Today, we're diving into a topic that's critical for anyone who's planning for retirement. It's called the bucket strategy. Stick around because this tactic is a game changer, we think, when it comes to addressing the three great risks in retirement. We'll get into that more in a little bit. But first, our disclaimer. The information that we're providing is our opinion, not necessarily that of our firm or the platform. We provide general info using only on the podcast and not any customized investment advice. Nothing should be construed as financial tax advice. You should consult with your own professionals about your personal situation.
Always, always. All righty, Kris, thanks for having me as always. And so let's get started. What is the bucket strategy that you're talking about?
Yes, this is not a way that you get rid of water on a boat that is sinking when they use that in the time of shipping. But the bucket strategy is a visual concept that's used to explain a way that someone can approach retirement planning. So picture for a minute, your retirement savings is split up into a series of buckets, and each one of those buckets is designed for a different purpose and a different time horizon. So instead of having one big pool of money, one bucket, you divide it into three or four buckets. Today, for the ease of explaining it, we're just going to use three. Now, before I go into the buckets, I want to talk about that one big pool of money. So that's what we call the total return approach. And what that is investing all the money in one account or one bucket and hoping that the return keeps up with what you plan on taking out. There's some big risks to that. There's some problems. It can work, but there are some issues with that. And that's what the bucket strategy hopefully addresses. And we'll get into those. So let's describe what those three buckets are. The first one is a short-term one that would hold cash or cash equivalents like CDs or money market accounts or short-term bonds. And it is designed to cover someone's living expenses for maybe the next 1 to 3 years. So think of this as where most of your income or all of your income would come from the first 1 to 3 years of retirement. It's a safety net and it's not anything that's placed in a risk spot. Okay. Bucket two, Collin, is the medium term or the intermediate term bucket. It holds investments like maybe bonds or balanced funds, maybe fixed accounts, things that have guaranteed returns. Moderate growth for this one, also less volatility probably than the stock market. And these buckets we usually design for maybe the 4-year to 10-year timeframes in retirement. And then the third bucket is the long-term one. And this one is invested in growth type assets like the stock market, maybe ETFs or mutual funds. Its purpose is to outpace inflation and also to provide income in a much later stage of retirement, hopefully 10 years or beyond. And that's important for a couple of reasons that we'll get into. So by dividing your savings this way, in our example, these three buckets, you align your investments with the time frame from when you're going to use them and what your needs are going to be over time, which can provide a certain level of peace of mind, and there's still flexibility built in.
Absolutely. Absolutely. I love that first bucket. It just gives the clients that peace of mind, knowing that they have that income coming in and they're not really worried about what's going on because we know where that paycheck's coming from.
Yep.
So you had mentioned the three great retirement risks. Can we discuss how the bucket approach addresses each one of those?
Okay. So let's talk about the first one. Let's start with inflation. So this was not even in the conversation up until 2022. We really didn't have inflation for a long time, not anything substantial. Then 2022 happened. We had a large amount of inflation, really high. A lot of people were kind of shocked or kind of snuck up on them. But you probably noticed how groceries, gas, and healthcare has gotten more expensive over time. Even a stamp, my wife and I were joking about this. We can remember when stamps were 23 cents. I think they're 75 or 76 cents now. So that is inflation at work. And over a 20 or 30-year retirement time frame, it can erode your purchasing power of your money, which just means what a dollar used to pay for, what that used to be able to pay for, it's not able to pay for that same stuff now because it's increased in cost. So this is where bucket 3, which is the long-term growth bucket, that's the growth assets, plays a crucial role. Since it's invested in things like stocks, which historically outpace inflation over the long term, it can help ensure that your money retains its value and hopefully grows. The beauty of the bucket strategy with this is that you don't need to touch this bucket, hopefully for a really long period of time, let's say 10 years or more, which gives it time to weather the market ups and downs as it grows. So with that long-term bucket, if we do have a down market or 2 down markets, we've got a time frame there where we can keep it invested and hopefully wait until it recovers and grows over time.
Got it. So what about mitigating that market risk? I mean, things are pretty frothy right now, but how would you address that?
Yeah, so volatility or market risk is the second great retirement risk that we see. And this volatility, as we all know, can create kind of a sinking feeling when your investments lose value because of a downturn. How many times have we gotten statements? We look at it and go, oh my goodness, it lost several $1,000s. What if this continues? What's going to happen? So if all or a majority of your retirement savings were in stocks, like that total return approach we were talking about, you might panic or maybe even sell at the worst time, which is when things are low, the worst thing you can do, especially if you have to sell in order to take withdrawals from your portfolio. We don't want to have to sell when things are down. So the bucket strategy mitigates the market risk by using the first bucket, which is the short-term 1 to 3 year cash reserves as a buffer. So even if the stock market takes a dive, your paychecks, your income are not coming from that bucket 3. You're relying on the cash to cover your expenses, and we don't have to sell the investments at a loss. Meanwhile, the medium term and the long term buckets can get left alone. So if they do temporarily go down, they have time to recover. This type of a layered approach allows you to ride out market volatility with a sense of security that you wouldn't have with that total return approach.
See. So if we address the longevity risk, which is the risk of running out of money, what are your thoughts on that, Kris?
Yep. Third great risk in retirement is longevity risk, which is living longer than you expect and the possibility that you could run out. So it's either a real or a perceived fear of outliving your savings. And we can help people figure out how real that fear is for them or how real that possibility is for them based on their lifestyle and what they've saved. That's something that we work with clients on all the time. But with people living longer than ever, this could be a legitimate concern for some people that are listening. So the bucket strategy, what it does to combat this is by spreading your investments across the different time horizons. Bucket 2 provides stability during the mid years of your retirement, maybe that 4 to 10th year, while bucket 3 is designed for growth that will hopefully sustain you in later years. And if we have that dedicated long-term bucket, it gives you the flexibility to adjust your spending or your investments if your circumstances do change. So oftentimes what we'll do is we'll use how that long-term bucket did to determine if the client maybe wants to take a raise in their income from year to year, or maybe we should keep their income at what it is. Maybe if they don't need as much money, we could pull back, but that gives us some flexibility there. Because our main concern is we want the clients to be able to maintain their lifestyle and give us the highest chance of not running out of money.
Right. So then how does this approach allow people to stick to their income plan?
Yeah, so imagine with that total return approach, I already mentioned it, you're getting statements for 5-6 months, it's all in one account, you're taking withdrawals, and you're seeing it drop maybe several thousands of dollars every month. You can see how that would create some possible anxiety. So just beyond the numbers, the bucket strategy, what we found to be really helpful is the psychological benefit. So what it does is it simplifies decision-making, and it gives us the confidence in the plan that we've put in place. Instead of worrying about market fluctuations or inflation every day, we know which bucket we're drawing from. We know what the purpose of it is. We know how long it's going to be until we're going to rely on the next one, all based on the person's time horizon. So that helps. You can't eliminate emotion. Money is an emotional thing, but we find that using those buckets is a better way of helping to deal with the emotional part of it in managing their retirement income and approaching the decisions we make from there.
Absolutely. It gives everybody that peace of mind knowing, hey, I have that paycheck coming in. So I appreciate it, Kris. And there you have it. That's the bucket strategy for retirement income. It's a great way to address the inflation risk, market risk, and longevity risk, all while giving you that peace of mind. So if any of our listeners have more questions on this or any other financial topics, feel free to reach out to us on the interwebs of lpfadvisors.com and email us using info@lpfadvisors.com. And if you like the podcast, be sure to subscribe and share the episode with your friends. And thanks for tuning in to the Confident Retirement Podcast. We'll see you next time.
Okay, everybody take care. Be well.
You've been listening to the Confident Retirement Podcast with Kris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.